All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be exploring how tax cuts as well as tariffs impact your aggregate supply as well as your production in general. Okay, so when it comes to tax cuts has to do with a government policy where the government, for example, in a recession, go ahead and reduce taxes, okay, for all the residents of the country. Now, when this happens, okay, suppose this is your aggregate supply curve, okay, and this is your demand. And let's assume that this is your potential GDP. All right. Now we know that at this point you have your equilibrium. Okay, this is your price level over here. This is your GDP. So our GDP. All right. So we know that at this point this is your equilibrium, and this will be the point at which, okay, your demand meets supply. Okay, so consumers are willing to buy what producers are willing to supply. And at this point, you have your real GDP zero, okay, and your price level zero, okay. So you have R zero and PL zero. Now, if for some reason, let's say in a recession, the government went ahead and reduced the taxes, okay, and went ahead and cut your taxes. In that case, what's going to end up happening is, okay, the supply curve, which is this curve over here, will shift to the right. All right, your supply curve will shift to the right, and this will become S1 with a new equilibrium over here, with a new RGDP or real gross domestic product, as well as new PL1. Okay, so this is PL1 over here. All right, so what basically happens over here is, okay, as the government goes ahead and cuts your taxes, okay, your supply, okay, goes up. Okay, your supply goes up as a result of which the supplier is able to produce more. Okay, and the unemployment rate is low. Okay, so your unemployment rate is low. Now, if for some reason the government went ahead and introduced a tax bill, okay, or let's say the government went ahead and imposed tariffs, okay, so in that case, what's going to end up happening is your supply curve will shift to the left because obviously the cost of production is high because of tariffs, and your supplier, okay, is not willing or cannot produce at a quantity that he was able to produce before, okay, because of the tariffs. As a result of which your supply curve over here will shift to the left. And because your supply curve shifts to the left, okay, this will be your S2. Okay, and this will be your equilibrium point. And we also know that at this equilibrium point, we know that at this equilibrium point, okay, your unemployment is, okay, the ideal unemployment rate would be at the full potential GDP or full employment, which is this line over here, this vertical line. Okay, so if you do have a supply curve, let's say the supply curve was to shift to the right because of tax cuts, okay, to the extent where your demand and your supply would meet at an equilibrium point, which is on the potential GDP. Okay, this would be your ideal unemployment rate or ideal employment rate, hence full employment. Okay, so this is ideal. Anything short of this will lead to unemployment. Okay, which basically means, okay, the more the supply curve shifts to the left, okay, the higher the unemployment. The more the supply curve shifts to the right, the lower the unemployment. Okay, so this is ideal unemployment. All right. So apart from that, this is Obeyed on behalf of V Electronics. Have yourself a great day.